Have you ever wondered if securing funding for your e-commerce or SaaS business means navigating a maze of credit checks and pledging your hard-earned assets as collateral? It's a common concern for entrepreneurs, especially in the fast-paced digital economy, where traditional financing models can feel outdated and restrictive. You've built something innovative. You've got traction and you're ready to scale, but the thought of a rigorous credit evaluation or putting up your personal home as security can be a major roadblock. Today, we're diving deep into Clearco's funding model to answer that very question. Does Clearco perform credit checks or require collateral? We'll explore their unique methodology, eligibility criteria, and how their revenue share agreement work, giving you a comprehensive understanding of whether Clearco could be the right funding partner for your growing business. So let's cut to the chase. The answer to the core question is a resounding no. Clearco generally does not perform traditional credit checks or require collateral in the conventional sense. This is a fundamental differentiator that sets them apart from banks and many other lenders. They built their entire model around assessing a business's health and potential based on real-time performance data, rather than historical credit scores or asset-based security. Instead of a credit check, Clearco's application process is heavily data-driven. When you apply, you'll be asked to connect your sales platforms like Shopify, Amazon, Stripe, your marketing accounts such as Facebook ads, Google ads, and your business bank account. Clearco's proprietary AI and algorithms then analyze this data to understand your revenue streams, marketing efficiency, and overall business performance. They're looking for consistent revenue, a strong track record of sales, and a clear path to growth. This analytical approach allows them to make quick, informed funding decisions, often within 24 to 48 hours. The philosophy behind this is simple. If your business is generating consistent revenue and demonstrating growth, that's a more reliable indicator of your ability to repay funding than a personal credit score or the value of your office furniture. This data-centric approach means that even businesses with limited personal credit history, or those that might not qualify for a traditional bank loan due to a less-than-perfect credit score, can still be eligible for Clearco funding. Now, let's talk about collateral. Again, Clearco operates differently. They do not require traditional collateral, such as real estate, inventory, or equipment. They also do not require personal guarantees. This is a massive relief for many founders, as it means their personal assets are not at risk if the business encounters unforeseen challenges. The funding Clearco provides is essentially an advance against a portion of your future revenue. This brings us to their unique financing model, the revenue share agreement. Instead of a loan with fixed interest payments, Clearco provides capital in exchange for a small, agreed-upon percentage of your daily or weekly sales until the advance plus a flat fee is repaid. This means that if your revenue fluctuates, your repayments also flex accordingly. In months where sales are lower, you pay back less, which can be a significant advantage for businesses with seasonal revenue or unpredictable cash flow. Conversely, when sales are booming, you repay faster. Think of it this way. Clearco is essentially purchasing a portion of your future receivables. To evidence this ownership interest in your future revenue, they may file a financing statement, but this is distinct from requiring traditional collateral or a lien on your physical assets. It's a key distinction that differentiates their model from secured debt. So, what does this all mean for you as a business owner? It means a few critical things. First, accessibility. Clearco's model opens up funding opportunities for a wider range of businesses, particularly those in the e-commerce and SaaS sectors who might struggle to secure capital from traditional sources. If you've been turned down by banks due to a short operating history, lack of substantial assets, or a less-than-perfect credit score, Clearco could be a viable alternative. Second, speed. The data-driven application process allows for much faster approvals and disbursements compared to traditional loans. This can be crucial for businesses that need quick access to capital to seize marketing opportunities, purchase inventory, or scale operations rapidly. Imagine identifying a profitable ad campaign and being able to secure the funding to scale it within days, rather than weeks or months. Third, flexibility. The revenue share repayment model aligns with your business's natural cash flow. This means no fixed monthly payments that could strain your finances during leaner periods. Your repayments are directly tied to your success, creating a more symbiotic relationship between your business and Clearco. However, it's important to understand the eligibility criteria to see if Clearco is a good fit for your business. While they don't focus on credit scores or collateral, they do have specific requirements. Consistent monthly revenue. Generally, businesses need to have at least 6 months of consistent revenue, with a minimum of $10,000 in monthly revenue. Some sources suggest this could be higher, sometimes requiring 12 plus months of revenue greater than $10,000 per month for invoice funding. This demonstrates a proven business model and predictable cash flow. Business structure. Your business must typically be structured as an LLC or corporation. Industry focus. Clearco primarily focuses on e-commerce and SaaS businesses. While they have expanded their offerings, their core expertise and funding solutions are tailored to these digital native industries. They fund things like marketing spend, inventory, and even SaaS operating expenses. Connected accounts. You'll need to be willing to connect your business bank account, e-commerce platforms like Shopify, Amazon, Stripe, and digital marketing platforms like Facebook ads, Google ads, to their system for data analysis. This is how they assess your performance and determine funding capacity. It's also worth noting what Clearco doesn't require in terms of documentation, which further streamlines the process. They typically don't ask for detailed business plans, financial statements, beyond what's available through connected accounts, or tax returns in the same way traditional lenders do. Their focus remains squarely on the live data from your connected platforms. Ultimately, Clearco represents a significant shift in how businesses can access capital. By focusing on data-driven insights and a revenue share model, they remove many of the traditional barriers associated with credit checks and collateral, making funding more accessible and flexible for a specific segment of the market, primarily fast-growing e-commerce and SaaS companies. If your business fits their criteria, and you value speed, flexibility, and retaining equity, Clearco could be a powerful tool to fuel your growth without the burden of traditional financial obligations. It's about leveraging your performance, not your past credit history, to unlock your future potential. With that said, thanks for watching, and until next time.